Yeah, so our view on interest rates is they're pretty much on hold here in Australia. I know there are some economists that are looking for 1 or 2 more cuts, but I can't see it happening. Property prices obviously are a bit of a concern in Sydney and Melbourne, and another interest rate cut would probably add, just more fuel to the fire. So we think interest rates are going to be on hold. And you look at what the market's predicting as well. It basically is saying the interest rates are going to be between 1.5% and about 2% for the next 5 years. You look at the yield curve. So there's no great impetus to increase interest rates anytime soon, but I can't see them cutting rates. So it's a pretty benign interest rate environment. Having said that, I think the US is raising rates, and I think bond yields will keep ticking up a little bit because they're still pretty, very low rates, even though they're not as low as they were last year. So that's a fairly benign interest rate environment for the share market. It does mean that we think that the market on a 6% yield, including franking, still looks pretty attractive versus 1.5% cash rate, bonds sort of sub 3, term deposits 2 to 3%, which obviously is where a lot of retirees have their money. They're not getting a lot of money out of that cash at the moment. Well, given that environment, we don't see it's not a real negative environment. I know some people have talked about the yield trade being over and all that sort of stuff, but if you actually look at the way that we run our portfolio, we're actually sector neutral anyway, so we're not really taking macro views. That's not our style. We're bottom-up stock pickers. We're picking stocks for income, but that doesn't mean that we're overweight. In fact, we're not overweight sort of the high yield sectors. We tend to be fairly sector neutral, but it's our active management of the portfolio is how we get extra income.